All right, welcome everyone to another Rocket Dollar webinar. We've got a couple in the books this year, but we're excited to have Equity Multiple and Daniel here as a guest. If this is your first time stopping by these webinars, the reason that we do them is for educational purposes. A lot of people, when they first call our line at Rocket Dollar, they really kind of know one asset class, or they have an inkling that they're interested in one asset, and they really don't know the wide breadth of alternatives. So they either want to learn more about that asset class, or they really want to branch out into something that they're not experienced in. So we always have a really wide length of experience. Some people, frankly, already know all this stuff, and they're just kind of looking, out there, what they can invest in and who's actively in business. Others, they really want to ask foundational questions. So all questions are valid. Feel free to ask anything. The only thing that we don't answer is like super specific support or to your specific IRA. You can ask a general retirement question. Probably a bunch of other people on the call have that as well. So Daniel, I'd love if you could introduce yourself.
Yeah, Brendan, thanks so much for having me on today. I'm Daniel Brereton, Director of Investor Relations at Equity Multiple. We're a real estate investing platform providing accredited self-directed investors access to a wide slew of different commercial real estate investment opportunities. So, not just investing in a single family home as a second home or a rental, but the whole wide array of different property types, capital types, and investment types, and really trying to bring that investment to our investors. I head up the investor relations team, so I'm talking with investors all day, answering questions, and also taking feedback back to our team. So I do a lot of these different webinars, and happy to be joining today. I guess maybe I can kick it off on the slides, Brendan.
Great, go ahead.
Cool. So, I'm sure all of our participants have been done on one of these webinars before, done a webinar in the past with another company. You can see your webinar chat on the side there, or if you don't have it up on the bottom of your screen of the Zoom screen, there's a chat button. Click on that. Feel free to drop a question in the chat as we're talking. I'll try to get to them as we are going here, but my slides should be pretty quick. And we will have maybe some questions and answers at the end. And I'll also be sharing a link for my contact information and also how to get in contact with Equity Multiple at the end of the webinar as well. But let's get started here.
Yeah, no, go into the Q&A first if you have that, and that just allows us to kind of manage and answer when the questions come in.
Great. So I've got today we're going to be talking about industrial properties. I've previously done a webinar with Rocket Dollar before where we talked about generally how commercial real estate works, how Equity Multiple's platform works, and what our general array of offerings are. But I think pretty poignant for where we are at right now in the recovery cycle from the post-COVID-19 world. And it's funny to think it's been 4 years since the pandemic really took hold of us, and we're still seeing the recurring effects of that. But I think industrial properties too are seemingly pretty resilient in this type of recovery. We've seen a lot of properties in other commercial real estate get pretty beaten down, but as we'll see, I think there's a pretty compelling case for this type of property in the continued recovery and beyond. But let's go a little bit more background about Equity Multiple. I know I talked a little bit about it before, but we are a self-directed investor platform for institutional quality commercial real estate. We're priding ourselves on both of our technology and our dedicated asset management. So we've got a in-house designed and in-house created investing portal. We pride ourselves on improving our technology continuously. And then a little different from some of our competitors in the commercial real estate investing space is our dedicated asset management. So we've got a team of 10 asset managers and real estate professionals, all one asset manager per asset. And they take that asset from when we close on the investment to when the investment eventually exits, is either sold, refinanced, or paid back. So you're not just alone. You're not just buying the investment with us and then off on your own with the sponsor. We're there with you. We are a dedicated fiduciary to that investment entity. And as I mentioned before, we've got a wide range of different types of CRE investments. Equity Multiple was founded about 9 years ago by Charles Clinton, who did a podcast with Henry Yoshida, CEO of Rocket Dollar, and Marius Scholzen, who's our CIO. And together, Charles was a real estate lawyer who wanted to invest in a lot of the deals that he was already working on. He saw how lucrative they were, but they were just out of reach. So he wanted to build a platform along with Marius, who has decades of experience in commercial real estate transactions, bringing those opportunities to dedicated retail investors. Background on CRE, in case you don't know, if you haven't invested in commercial real estate before, it's more than just a fix and flip or a single family home that you rent out with a friend. There's a lot of different types of real estate. We'll go over the different property types, but really CRE is any property that you invest for an investment purpose that's beyond just your single family home that you live in. It uses a lot of different types of structures, debt investments, equity investments. Today, I'll be talking mostly about the equity side of that. Those have the potential highest returns, similar to owning a stock in the stock market. You're buying a piece of that investment company and seeing the appreciation potential. So let's get into what is commercial real estate. There's a lot of different property types when it comes to commercial real estate. I've shown the core four here, and I call them core four because they make up the majority of transactions and investments, and they have a lot of key usage in the economy. Everyone needs a place to live. That's multifamily. Everyone pre-pandemic had a place that they worked, that was office. And anywhere you have to buy things or go to an in-person meeting like a workout class, a gym, the grocery store, that's all retail. And industrial at the bottom there is the stuff behind the scenes of retail and behind the scenes of offices that gets things in the economy moving. So we've got manufacturing plants, warehouses, distribution centers, factories to make things like pharmaceuticals or even manufacturing facilities. And there's historically strong demand for these core four asset classes, but as we're seeing in the post-pandemic world, multifamily and industrial have really been the most resilient. Demographic shifts, economic shifts, have really created a lot of opportunities. I'm working from home right now. I think Brendan is also working from home right now. I go into the office a couple days a week, but we're all approaching a bit of a different type of office environment and what it means to work in an office, and not just the reduction in the office facilities, but the distribution of where people in the country are living. The pandemic showed a lot of gaining areas for multifamily and a lot of gaining areas for economic shifts because demographically, people moved away from high-cost centers to lower-cost living areas. So not just the amount of office, but where that office is located or what it means to work in an office has changed. Retail typically is a pretty good investment. However, with e-commerce and a lot of on-demand shopping or e-commerce shopping, there's been a lot less of the big box chains and a lot less of the traditional retail anchors that you have seen. Grocery stores are still going to be there. You can't get your food necessarily delivered immediately, or you want really fresh food, so you have to either pay a premium for online or go to the store itself. But multifamily and industrial, as I've been saying, have been those two that have been very resilient through the pandemic. Multifamily prices have really increased significantly over the last several years. And a change in how we do business as an economy, both distribution chains and supply chains, have really put more pressure on the industrial sector to pick up.
And Daniel, we've seen this almost like yo-yo effect too between the suburbs, the city center and the suburbs. And what you're telling us is it seems like the office and retail has just been hit the hardest by that double boomerang back and forth.
Precisely. Yeah. Not just. There've been a couple of articles in the Wall Street Journal about doom loops and how just Detroit is finally, recovering from that. But how places like San Francisco and even something like, St. Louis and even New York, New York is still a tier 1 city, but there's a lot of the neighborhoods which are, not as vibrant as they might have been 4 years ago.
A lot of turnover in the Austin area for downtown to back to the suburbs to back to downtown again. You've just seen constant retail or business turnover down there from all of that yo-yo activity, and rent is still rising, for some of these retail, but some of them are sitting empty, for months at a time.
Yeah, and I mentioned about population shifts, and people are leaving high-cost areas like San Francisco and New York. Austin and Houston have picked up. Austin's housing market has really had a big bubble and it's come back down to earth. But some place like Chicago, which has never been the top one, is now, I think, one of the best performing multifamily markets in the country, according to recent research. So huge shifts. But let's get a little bit more into specifics about like what types of industrial properties there are. This is a chart that Green Street is presented for us. Green Street Advisors, they're a commercial real estate investment research firm. They provide a lot of the sector reports and a lot of the general knowledge that we use at Equity Multiple to get an understanding of what the market is doing. But they put together this really good chart of what the logistics flow looks like in the country. You know, we both have air transport, we've got sea transport that are taking goods and bringing them to the United States. So there has to be a big facility to have that. That's the air cargo facility. You know, and you don't just get a delivery truck from that air cargo facility. It's got to be broken down into smaller pieces for the smaller distribution centers or the fulfillment centers. And even in those distribution centers, it's not going to be these big distribution centers anymore. I've got a couple of specific investments that we currently have available that are exploiting these smaller fulfillment centers. You know, Amazon doesn't just have a large facility where they're sending individual trucks from. They, again, break the supply chain down into these smaller pieces that are a lot more flexible. And those are those sorting and delivery hubs too. So you can see there's always something in the supply chain related to industrial properties, from manufacturing the investments to sorting the goods, storing them, breaking the supply chain down into smaller pieces, and eventually getting those goods to the consumer. And we're seeing a lot of conversions too, from old style factories like pharmaceuticals to large flexible spaces. And even here in New York, there's a couple of these grocery delivery or small goods delivery companies, and they've taken over a lot of these old big box stores and put in distribution or fulfillment centers because, you know, they just need a space for their delivery people to gather, get the goods that they need to put out, and then distribute those goods throughout the neighborhood. Now, I mentioned a couple of the trends that are, I think, pretty compelling when it comes to pushing industrial up and making it a bit more of a very attractive area. E-commerce is one of the biggest trends in the last, you know, you might say 20 years. Amazon got on the scene and it was the death of retail. Etsy is on the scene, and now all these smaller mom and pop stores have a place and a platform to sell their goods, which, you know, is excellent for their businesses. But again, it leads its need for more distribution places and more storage of those types of goods. And even in grocery, I mentioned people still need to go in person to get their groceries, but there's a lot of investment in places like HelloFresh or you know, a lot of grocery delivery services or you know, prepared food delivery, that people are still getting that fresh food delivered by a delivery person online. So they're going online, they're doing a lot more of their commerce there. And what we talked about in our investment committee is how this is just affecting the supply chain. You know, people want fresher food, which requires refrigeration at every stage of the distribution channel. Not only is it just the large distribution centers and then the grocery store which needs it, but every point along there needs some sort of adaptation to the changing consumer preferences for fresher food, cold food, even, you know, more intricate supply chains and logistics are required. So we're also seeing not just the types of distribution centers, those capital improvements to those distribution centers, but you know, trying to be more efficient with how we distribute goods. I think, you know, Amazon's big claim to fame is being very efficient with how they distribute their goods to their customers. And I think one of the big improvements that they had is anticipating where they would need goods to be and storing extra pieces of merchandise in areas where they would expect it. So they're anticipating where the consumer is. That requires a lot more thinking, but it requires those storage facilities to be built or those warehouses to be put in place in those key areas that they see as very important. And
Daniel,
sorry, go ahead, Brendan.
Yeah, we've seen other companies, you know, seem to try and catch up with Amazon and Walmart. Like I hear about Shopify trying to increase their distribution network flows for some of these smaller businesses. So how have we seen like other businesses try and like catch up with the Amazons and the Walmarts?
Yeah, it's very interesting because most people talk about those big players, the Amazon, Walmart, I think those are the big ones. But Shopify is a very good example. I mentioned Etsy, which is not the same type of goods, but even direct to you know, specific retail businesses, you know, high fashion brands, or you know, places like Adidas or Nike, they're using their storefronts now as their distribution centers or as their fulfillment centers. So they've already got that there, but that they have to rethink how they're distributing their goods. It's not just you know, having stuff in stock that they would anticipate people would buy, but now they've got to think, okay, I've got people buying online that are then going to fulfill to or pick it up at the store. I now need to shift things around and not do so much anticipation or stocking, and be more adaptive to what the consumer
Yeah.
is looking for.
There's all these businesses that, you know, maybe 10 years ago, they weren't competing with Amazon at all, or Amazon was seen as inferior. But with the 2-day shipping, you know, all these smaller businesses that, you know, had 5 to 7 day shipping now feel the pressure and need to compete with the 1 to 3 day shipping times that Amazon is Walmart is getting. And then Walmart just started doing that. You know, they basically have their own subscription that's kind of like a Prime-like subscription now. I'll say my reviews, they weren't quite nearly as good. They lost about 3 deliveries when I tried it out. But, you know, the bigger companies are trying to compete with Amazon, and medium and small companies now have that urge to have drastically higher expectations of logistics.
Yeah, and I think Amazon, for all its growth too, has taken a bit of a hit to the reputation, in my view, about the quality of goods that they're putting out and the trustworthiness of the sellers. You know, you can see 10 different people offering ostensibly the same item. You know, it's the same branded item, but with different prices, different pictures. So, you know, I think for me as a consumer, and I think there's a lot of people like me who I would want to go directly to the retailer's website and know that if I buy it from them, I can either pick it up very quickly, or I can get it in about the same amount of time for a similar price. So yeah, the retailers are definitely fighting back against Amazon, and finding ways around their, well, we won't say monopoly, but because they don't necessarily have one, but you know, pretty much a monopoly that they have on the shipping. And last is those demographic shifts we talked about. Again, people are moving from high cost areas to low cost areas. They're moving closer to family or where they maybe are their hometowns. So there's a huge wave of people moving from California into Texas. People from the Northeast are moving south to, you know, Virginia or even Florida. I think Goldman Sachs even moved one of its trading arms from New York into Miami during the pandemic. So there's a lot of people trying to move up and down the coast, you know, moving to much more hospitable areas for living and thriving. And again, that changes the supply chain. You know, if you don't have all of your goods going into New York or LA or San Francisco anymore, you've got to now set up distribution centers that are going to allow you to dogleg into these other areas. And it's not just big changes, everyone moving at once. It's now a bit more of a distributed distribution of people. So you've got a lot more smaller pockets of people living there, which means that distributors and manufacturers are now focused on being a bit more adaptable with their supply chains, not really standing up these big distribution centers, but even in these flexible warehousing spaces, which we'll talk about later, you know, taking up a small portion there for when they need to use that space, expanding when they need to, contracting when they need to, and just being a bit more nimble for their supply chain. And that also came out of the COVID pandemic. You know, we had these big crystallized supply chains, which were optimized and, you know, very, very fine-tuned. But as soon as an outside shock hit them, they were no longer useful, and we had, you know, they had to rebuild and recover from that. Now, let's talk about what markets are. I've talked about Florida, I've talked about Texas, and you can see these are the top 15 markets rated by Green Street for industrial. Miami, Fort Lauderdale, Palm Beach, and Orlando are all in the top 15. So, you know, a good third of the top markets for industrial real estate are in Florida. Now, there's a lot of reasons for that. There's older populations moving to Florida. There's a lot of investment being put into Miami to renew a lot of their industrial areas. You know, I can't remember the name of it, but there's that big luxury arts district that LVMH, you know, Louis Vuitton Moet Hennessy, has put a lot of money into that to bring a lot of younger people and revitalize the area. but it's also a key port for South America, Brazil bringing imports, the Caribbean, Central America, and a key entry point for those goods coming in and into the rest of the United States. And beyond that, there's a lot of produce and everything that comes from Florida. So again, it's a key state. It's a much larger state than people realize, and very crucial for bringing in a lot of industrial warehouse space. And then northern New Jersey, outside of New York, if you've ever flown into Newark Airport or driven through northern New Jersey, you might get the sense that New Jersey is all just factories and warehouses. And northern New Jersey, outside of New York, is a lot of those areas, because it's a very key area for cheap land to store goods that are going to have to pass through the Boss Wash corridor. So New York is one of the largest natural harbors. So it's a lot of goods coming in through New York Harbor that are then being distributed along the Northeast corridor. And then other than that, we've got some of the key tier 1 cities like Atlanta and Los Angeles, and then Raleigh-Durham for the Research Triangle.
Yeah.
Key though is, so go ahead.
Yeah, during COVID too, the coasts, all these supply chain logistics, all these businesses that were really dependent on, the shipment from China or from Europe or from South America comes on time every single time. Now people are used to a little bit more of like shipping interruption and how they have to prepare for their business. So whether it's a port city or getting something to the Midwest, a week later, they're all trying to see how can they be a little bit more resilient.
Yeah, and it's unfortunate to have these big shocks to really realize it. But I remember I was living in LA for a couple of years during the pandemic, and outside of LA Harbor, you could see I was working in 1999 Avenue of the Stars, looking out over the Pacific Ocean, and there's just these container ships just hung up. They're stuck. They could not come into the port during the pandemic. And even, something like, the bridge collapse that we had recently just disrupts these supply chains. So again, we have to be very adaptable in finding different ways to get into it. And, not to go too historical, but it's also the reason why the Panama Canal was built, or the Suez Canal was built, to force more access to a lot of the areas to make the supply chains a bit more easy.
Yeah.
And those were more political based, but I think you get the point.
I've noticed the financial journalists now, when there's one of these ships gets interrupted, they're actually starting to list like what most of the items were on that ship. So like it came out like parts were on the Baltimore ship and stuff like that. So now even the journalists are starting to try to see like, okay, what 3 industries might be interrupted by this port. And for some, it's a really big deal. For others, it's, a big nothing, because they have another avenue.
Yeah, and that's those hedge funds really trying to
Yes.
dive into it.
They're probably helping send the reporters out there and help pay for their trips to investigate.
Well, one more aside, and I'll continue, is there was a hedge fund that actually set up its own newspaper, and online newspaper. They paid a bunch of journalists to do investigative journalism, and then brought that information in. Before they published it, they traded on that information, and then they published their own investigative journalism. So it's a fascinating scheme, but unrelated to industrial real estate. Great. So I think with that, any questions come in for about this specific industrial side? Because now I'll get into what we're seeing at Equity Multiple, what opportunities we've seen for that. So if you have any questions, please drop them in the chat. Otherwise, we'll continue on with what we're seeing right now in terms of opportunities. Before I talk about our investments, again, a reminder, this is not investment advice. This is all education. You have to consult with your advisor or do your own due diligence before investing at all. All investments involve risk, and we require that investors download and read the private placement memorandum before investing in any of our offerings. With that being said, let's talk about our platform. We've got equity investments, we've got debt investments, income generating assets. Obviously, for an IRA, one of the key factors is that you've got that long-term compounding growth. And most long-term investors, I think, in their public markets IRA, not their self-directed IRA, will invest in stocks for the long haul. They'll invest in stocks, they've got the compounding, the capital gains tax isn't a thing because it's a tax-deferred account. So I think it was appropriate to bring our current equity offerings here. Again, you'll have to make your own decisions about the appropriateness of these investments, but for growth-minded investors, this is going to be those types of investments. This is in our grow category. In the top right hand of the slide, you'll see that yellow box. That's a symbol for our grow investments on the platform. So if you see that symbol on the equity multiple platform, that's where you can see a grow investment. Portal Co-Warehousing is down in the Orlando area. Capstone Equities we've worked with before, and this is the co-warehousing that I might have been alluding to before. They're taking a pharmaceutical factory, they're buying it at sort of a cut rate price, and it's a very tight market right now. There's a lot of smaller mom and pop shops, smaller warehouse space needs, and this is where they're coming in, they're going to refurbish this pharmaceutical factory, clear it out, and insert this co-warehousing concept. So co-warehousing is kind of exactly how it sounds. It's sort of like a co-working space, like a WeWork that you might work in. So they have these big flexible walls they put in. They can adapt the space to their tenants' needs and really customize exactly the amount of space they need. One of the best parts about this as well is that because they're providing this service for smaller tenants, they get to charge a much larger premium to market rents. I think when we discussed this in our investment committee, we saw that they were underwriting, potentially double the price per square foot for market rents. Now, you might be wondering if that's even achievable, and they've already done this at 5 other locations, I believe, or 4 other locations in the United States. This is their 5th. And they've been achieving those rent premiums that they're forecasting. And especially in a tight market like Orlando, where there's a lot of need for small bay, small storage facilities, they see this as a compelling opportunity to bring in this exact service that people need with a premium operating and being able to charge that premium that they expect to have. This is a 4-year hold investment. Most investments on our platform for the grow category, those equity investments, are going to be between 3 and 5 years. That allows for the business plan to be put into effect and for the market to catch up to where they're seeing it for the rents. It could be shorter than that, but typically it would be around that 4-year period. And also, this is not just a back-ended investment. This is not just a capital appreciation. We expect there to be high cash on cash for this offering, somewhere around the 10% range or so. You'll have to check out the entire investor packet and offering page to see all of the returns or all the return potential. But this was a pretty compelling one for a very unique shift to the business plan for this type of property. That investment of $15,000 is what our typical minimum is. If you're a first-time investor on the equity multiple platform, we typically can offer a lower investment, sometimes as low as $5,000. So it's a great way to try out one of our investments or to diversify. And so instead of having to put all your money into one, you might be able to diversify outside. The next investment that I have on the platform right now is the St. Cloud Multi-Bay Industrial. Ultimate Realty is a sponsor, and we've done 5 deals with Ultimate Realty so far in the past. They're a Northeast-based sponsor, but they've done this exact type of business plan in Florida already. Previously, we've worked with Ultimate Realty on a Pods storage facility. So Pods, the moving and storage company, they have these purpose-built facilities for their pods, their storage containers. And Ultimate Realty is currently in negotiations to bring that up to market. Now for the St. Cloud Multi-Bay Industrial, Multi-Bay describes, as you can see in the picture, these sort of separate buildings all on one property. So it's kind of, you can think, a portfolio of a lot of smaller buildings all managed on one property with one access point and one property manager. Multi-Bay is great for smaller businesses who want the ability to have a separate space, maybe have a front office, and also some storage space in the back. I think one of the tenants is like a trampoline company. One is trying to put maybe a swimming pool into one of the places of these small buildings. So there's a lot of multiple uses that can be put into this industrial property, as well as something like we've discussed with small distribution centers or small businesses who, like Brendan and I were talking about, want to compete with the larger players and have their own space, have their own storefront, and be able to have their space to distribute their goods. Again, Ultimate Realty, their game plan that they've done already in this area is to go in, find mispriced properties with below market rents, push those rents pretty high, and they've have a reputation for themselves in the Orlando area for getting their way when it comes to increasing those rents. I've talked to them on a podcast that we did with the Ultimate Realty sponsor before, and they talked about how when they go into these properties, the tenants know they're going to have their rents raised. It's better to just accept those rent raises as proposed because they know that the market is so tight. And when we talk about when a market is tight, it means that, if you've got 10 people that are looking for a place to live and there's only 9 properties, well, someone has to bid more for that property than someone else because there's just not enough space for everyone who wants a space in that property. They've done this before, as I said, and there's been strong rent growth. As we saw on the slide with the top 15 markets, Orlando was up there with the revenue per available foot growth for Orlando, and St. Cloud is in that Orlando market as well. Again, 3-year hold, and I think we're targeting somewhere around a 6 to 7% cash on cash for this investment. And last, for our investors on the Equity Multiple platform is Northern New Jersey. Northern New Jersey, as I mentioned, was in the top 5 for our industrial markets from Green Street Advisors. This is actually a co-sponsored one from Equity Multiple. Equity Multiple is going to be a co-sponsor, meaning that we will have much more direct control over the investment, removing a lot of layers between the asset management team and the actual asset. And Snowball Developments actually worked in the same building as us. So we were very close with that sponsor. We've done one other investment with them before, which has been achieving a lot of the premiums that they've been searching. This one is a bit more of a heavy value add. So if you've invested in commercial real estate before, you might have heard the terms core, core plus, and value add. And value add is on the higher end of the spectrum for the amount of work that has to be put into a property. So it means that you could either need some light cosmetic upgrades or an even heavier amount of work where they have to put on a new roof or pave the parking lot. And that's exactly what they're doing here. He's going in. Brian Kerr, who I did a podcast with as well. He's going in, putting in a new roof, paving the parking lot, painting everything to bring it up to snuff and make it much more attractive to potential buyers. Infill in the title suggests that this is a very supply-constrained market. It means that if you want to put in a new building, you have to knock down one building and then rebuild another. So instead of knocking down this one, he's going to take the time to actually improve it, make it a much better facility, and lease it up before stabilizing it and selling it down. Stabilization means that it achieves the amount of rent and the occupancy of the building that could be maximized or expected to be maximized in that area. The tenants are on long-term leases, and then once it's stabilized, you can sell it as a more stable property. This one is a 3-year hold, and the sponsor's already gone to work. We did an initial funding round to Brian Kerr at Snowball Developments, and he's already gone to work with the roof and the paving of the parking lot. And I think he already has several prospective tenants on the list there. So 3-year hold, and it's very attractive.
Yeah, do you know what this building used to be before this renovation that's happening?
Yeah, it was actually, I think, just a general warehouse facility, but the property fell into disrepair. I think there was an old chemicals storage facility there that they had to clean up as well. So, there's a lot of, you might call it hair on the deal. And if you can look past that and see what the potential of this property is, just like fixing up anything or, polishing anything, you can see the value below it, put the work in, add value to the property, and then sell it off for a profit.
Okay. We had a question. I think it's a little bit taxes, so we'll talk as much as we can, but we're not tax advisors here. So Mr. Ved had a question about a K1 versus a 1099 for debt offerings. Can you please talk about it a bit? So I believe, Daniel, that I think this is just like a generic kind of tax form question.
Mm-hmm.
You're going through an IRA, sometimes clients freak out the second they get a tax form. If you're in an IRA, you can typically just hold on to that, and especially a K1, you just keep it for your records. Now, if you're
So,
investing through cash, a K1 or 1099 is quite different.
yeah. Yes. The one thing for investors in equity investments through their IRA that I've seen is dealing with unrelated business taxable income, UBTI. Obviously, I can't give tax advice or project what that UBT might be, but I've had lots of IRA investors come and they're okay with taking that UBTI because of the high potential upside for a lot of these projects. And they see it as just the cost of doing business for an IRA.
Yeah,
It doesn't disqualify the IRA at all. It's just part of doing business for an equity investment.
yeah, that is something to be aware of, the UBTI. And a good thing to remember is if the property or the investment does have a lot of improvements going on, you could possibly talk to a CPA, or Rocket Dollar can recommend you one that if you do get hit by this UBTI, but like say for this New Jersey one, there's a lot of renovations going on. If those costs are passed on, and you'll have to talk to CPA about this, you could potentially reduce that UBIT. K1 is very, very typical to get for these investments. A 1099, really depends on what type of 1099 it is. Definitely talk to a tax advisor. And if you do ever get one in a retirement account, do not start freaking out right away. Just stay calm, try and talk to a CPA. You can mention it to us. We cannot give tax advice, but we can generally just give you generic next steps to get started.
Yeah, and you mentioned about the cost pass through. A lot of these investments are going to have a large amount of depreciation pass through that could potentially offset a lot of gain for taxable investors. These three that I've shown so far are all K1 receiving investments. They're equity investments in a partnership, so they'll receive K1. Last, not to overload anyone, but these three that I showed are industrial properties. What a lot of investors do on the equity multiple platform is they'll start with our Alpine Note. That Alpine Note is a short-term debt investment, so 3, 6, or 9 months, offering yields that are significantly higher than a cash investment might be. So these are not FDIC insured, they're not bank products, but they are short-term real estate backed notes. They're backed by dozens of real estate transactions on the equity multiple platform. And they mature so quickly that a lot of investors use this as a way to feel out our platform. I say it half jokingly, but we are all just a bunch of strangers on the internet at the end of the day. So I think it's important to understand that we're a trustworthy company, that how your money is going to work at equity multiple. Give it a try, and then maybe expand into other ones. Also, investors might use this as a holding period for making decisions. So they invest so that they can still earn an attractive return over inflation or over the cash rate. And then when they're ready to make an investment, they've already got their money, been working for them, that they can move into another investment on the equity multiple platform.
That's a very common ask right now, is interest rates where they are. Clients are asking for fill-in investments or short-term investments that might be of some kind of interest. And I think it's worth going into that statement, Daniel, where you said it's backed by real estate. I think it's good to kind of explain what that actually means. So if you said there's dozens of properties, are these real estate business going out and getting short-term loans, or do they maybe have a much longer loan? It's just the investors are coming in and the investors are termed at 3 to 6 months, 3 to 6 months.
Sure. Yeah, so equity multiple, we use this as a short-term facility to bridge the gap between the time that the sponsor closes on a transaction and equity investors fund the investment. So, sponsor comes to us and says, I've got this great industrial asset in Orlando. I need $3 million from equity multiple, and I need it in 15 days. And we're like, wow, this is a great industrial asset in Orlando. We want to fund $3 million. So we'll take some of the short-term notes, Alpine Note cash, and we'll back that $3 million of property with some other investor capital in there for the equity. And then after those 15 days, then we'll syndicate out that remainder of the $3 million that we were on the Alpine Note facility.
Okay.
But we've done that for, call it 30 or so different real estate transactions. So, of the $40 million, I think, that we have in the Alpine Note facility, it's all spread around across different types of real estate properties.
Yeah. And, just for the viewers out there, real estate, they want to start working right away, and they don't want to be losing money sitting on a deal or sitting on a property that maybe is vacant, or, maybe they can't get quite as good as a tenant because the renovations haven't started. They might lose like a top tenant that they might be willing to sign up. So fundraising takes time. And IRAs take time as well. I think everyone on here knows that. So if you can get the capital into these businesses quickly, that gives time to fundraise, on the other sides of the business.
Yeah, and obviously I can answer any other questions that we have. You'll see that there's that equitymultiple.com/boost. I'm going to drop that in the chat as well. Everyone here. That will take you to our website where you can sign up. It just takes your email address to browse our offerings. And by signing up using that link, you'll get a 1% performance boost, which will add for your first investment with Equity Multiple, an extra 1% annualized return on your investment. Now, I've gone over a lot of information. We talked generally about our industrial real estate, but I'm also going to provide my calendar link for people to get access to my calendar. You can schedule a meeting with me. I think the outside of just our asset management team is we're also trying to be one of the more available real estate platforms out there. I think one of the big things that our investors keep saying to us is we're one of the only platforms where you can get someone on the phone. We're one of the only platforms where our CIO or our CEO might even sit down with individual investors to talk about our business. But yeah, that's all I had for discussion today, Brendan. I don't know if there's any other questions in the chat that you see.
Yeah, last call for questions. Thank you everyone for coming. We'll just wait a little bit here. Just have another one come in. Okay. So yeah, Mr. Ved, we're Rocket Dollar. This is a Rocket Dollar webinar. We work as the IRA servicer, and then we have a custodian digital trust on the back end that actually holds all of the IRAs. So at Rocket Dollar, we enable people to start a Roth IRA, a traditional IRA. You can talk with our sales team about which IRA is best for you. And then that allows you to go invest in investment like Equity Multiple inside of a traditional and a Roth IRA. So please do follow up with info@Rocket Dollar, and we can send you a message after this, to get in touch.
Awesome. Thanks, Brendan. Thanks for having me today.
All right. We had another question from Pat come in. Is it easy to identify equity deals versus notes only? So maybe we can just kind of go, what's the difference between an equity deal versus a note?
Sure. So the Alpine notes are in our keep category. The Alpine notes are always going to be 3, 6, or 9-month maturities. You'll know it because it's called an Alpine note on our platform. The equity investments are always going to be called, you'll be designated on the offering card on our offering page as an equity investment. And you'll be able to see that just by, again, that little icon, that orange or mustard colored box as well. If you ever have any doubt or just want to know what type of investment you're getting into, always reach out to us at ir@equitymultiple.com, and you can, we'll be free to answer any questions, talk through any of the investments. But we typically make it very clear what type of investment you're getting into, and whether it's a debt investment, a short-term note, an equity, or preferred equity.
Yeah, and obviously most experienced people already know this, but just know, like, when you're getting in a type of investment like that, debt is typically a much more expected return with a certain amount of risk, where equity investors are definitely, they might be sacrificing some, cash payment to really try and see if they can get that upside at the end of the hold of the investment. So you really have to decide what's best for you, and what kind of suits your investment goals. And I think a good thing to think of is, you have your stocks and bonds portfolio. The S&P 500 people think is their equities, and the bonds they think is more of their debt. So definitely start planning. If you're going to make a real estate investment, don't load up too much on one type of investment without thinking about how it relates to your overall portfolio.
Yeah, and I think one other thing on that too is, you mentioned, stocks and bonds and, diversification. Some people go in saying, oh, I just want, bonds, or I just want debt investments because those are safest. They are higher in the capital stack, but, proper diversification, like in any investment, is very important. And, it's very important as well to diversify across as many investments and over time as possible to capture the true diversification benefits.
Yeah, and we're getting a couple of people in the chat, they really want to hear more about self-directed IRAs. So, I let Daniel have a lot of the floor today. We have a lot of content. We had a really good real estate focused content. It wasn't an investment platform like this. It was more like property management, but it kind of goes over a lot of the tenets of how to use a self-directed IRA, how to invest in real estate with that IRA. So that one was just a couple of weeks ago. So feel free to go through our YouTube channel. Feel free to talk to our sales line. And we have a couple of just how does real estate work in an IRA type of basic articles on our website that we can follow up with you after.
Great.
All right. Thank you, Daniel. Thanks so much for being here.
Thanks, Al. Have a great day now.